Let me show you where I think a lot of money is going to be made over the next 3 or 4 years. And we're not talking about chasing the artificial intelligence trade, what's already working, or just garden variety public stocks. I'm talking about distressed debt and distressed private equity. Most investment portfolios are built the same way. They're pro-cyclical. When the economy's doing well, stocks go up. When interest rates are coming down, bonds go up. When the market environment is good, everybody makes money. That's what I call a bull market genius. We want to make money when everything isn't going so well. So we have investments in all of the pro-cyclical aspects, and we have investments in counter-cyclical investments like distressed debt and distressed equity. I'm Nick Bartolo, the founder of Essential Partners, where we invest money for business owners after the sale. I spent 17 years on Wall Street investing in stocks and bonds on behalf of large institutional investors. Right now, we're deploying investments for our clients in distressed debt and equity investments. In client portfolios, we want to allocate capital and invest in strategies that do well and are opportunistic when all of the pro-cyclical investments are falling apart. Because when the environment changes, portfolios and portfolio holdings struggle at the same time if you don't have counter-cyclical investments. The best investors, they think differently and sometimes contrarian. They always have part of their investments in opportunistic strategies that are doing well when other areas are struggling. And right now, one of the biggest opportunities is coming from something very simple: too much debt. There's a quote from Warren Buffett that nearly everyone knows. You never know who's swimming naked until the tide goes out. Over the last 15 years, the tide has been very high. There's been ultra low interest rates, too much leverage, and just debt everywhere across the system. And a lot of businesses, especially in private equity, were built on these underlying assumptions, which now are wrong. And when the assumption changes, it creates two things: problems for some and opportunities for others. I want to walk you through a simple example of where we're seeing opportunity. Let's say you have a private equity transaction of a company that was doing $10 million in EBITDA. In this transaction, this private equity firm put 6.5 turns of leverage on that $10 million of EBITDA. That means that the total debt was $65 million. When there's $65 million of debt in a private equity transaction, that's usually financed at a variable interest rate relative to the Fed funds or the standard overnight financing rate. That's like way too much detail for that acronym of SOFR. So let's imagine that this Fed funds rate was 1% when this transaction happened, say back in 2020 or 2021, which was quite common at the time, and valuations on private equity were sky high. So if you have a variable interest rate of Fed funds rate plus 6%, that transaction was essentially financed assuming 7% interest rates. However, the Fed funds rate is no longer 1%. It's approximately 4%. So that 4% rate, if you add that 6% spread, we're now at a 10% financing rate, which is a very different environment, 10% versus 7% when you're thinking about financing this business and the interest expense associated with it. Now let's just run the math. If you have $65 million of debt financed at 7% when the Fed funds rate was 1%, that's $4.55 million of interest expense. However, when that same amount of debt, $65 million, is 10% interest rate, now you have $6.5 million of interest expense every year on a business that was doing $10 million of EBITDA at the time of acquisition. So let's take some liberties here and let's assume that business isn't quite as good for many businesses as it was back in 2020 or 2021 when the deal happened. Maybe there's been some lost customers. Inflation has been quite high over the last several years. So let's say the cost of the business has come up. Maybe there's been a new competitor in the market. Maybe it was even a software company that's now being disrupted by AI. So let's further assume in this example that that $10 million EBITDA went down 30% to $7 million. So now this is where it gets uncomfortable, but this is where the opportunity comes for investors that can be opportunistic. So now that business is doing $7 million of EBITDA and interest expense is $6.5 million. That's tight. Okay. And that creates a valuation mismatch from the debt, the equity, how private equity views it, and how opportunistic investors across debt and equity would view this opportunity. If we take it a step further, under real world assumptions, when you think about capital expenditures of the business, working capital, operational volatility, maybe there's more cyclicality in the business, you now have an unsustainable capital structure. And an unsustainable capital structure is simple. It means there's too much debt on the actual underlying cash flows of the business. So now a company with $10 million in EBITDA only has $7 million of EBITDA, but $65 million of debt and all of this interest expense, $6.5 million. So that private equity owner is going to look at this and think, do we even need to continue to be involved? Should we be writing down our investment? What are we going to do with all this debt? How can we refinance this? And that's where the opportunistic capital can come in on favorable terms. And so we go back to Buffett. This is actually the tide going out in real time. So when the capital structure gets tight, the equity value starts to disappear. The lenders gain the leverage, and the overall flexibility of the equity owners disappears. And look, that private equity value that once looked valuable, that these folks thought were going to return 3, 4, 5, 6x, that evaporates. So most people see this and they think something's wrong. I better stay away. On the contrary, opportunistic or distressed capital can run towards these opportunities because oftentimes you may have a good underlying business, but a broken balance sheet and capital structure. So in these situations, when they become stressed and unsustainable, capital, fresh capital needs to enter the picture. The equity needs to be reset. Overall debt needs to be lowered and on favorable terms. And when that happens, the terms do change, but in our favor. Look, this is how distressed investors like Howard Marks and Bruce Karsh made billions of dollars. Not by chasing fads, not by buying what's hot, not what's on the front page of the Wall Street Journal. They did it by stepping in opportunistically when other investors were fearful. And so what distressed debt funds do inevitably is they restructure the debt and buy it at a discount. They can receive equity at a very low valuation by providing new capital to create a more sustainable balance sheet. And this is essentially the risk getting repriced properly that leads to favorable returns in the future. So it's the same business, it's just a different outcome in a more sustainable situation. Now let's bring this back on how this would fit into a portfolio. Most portfolios, they're designed for things going right. I call it pro-cyclical. The economy's strong, inflation is subdued, everything's going well. That's pro-cyclical thinking. Portfolios that are structured to have economic balance and also counter-cyclical properties, they have holdings like distressed debt and opportunistic credit, where we're deploying capital in opportunities when things aren't going as well. That way, those returns can be harvested into the future when times improve. And look, we have plenty of holdings in our portfolios that do well when times are good. The US being the largest individual holding in public stocks of nearly all of our client portfolios. But when conditions reverse, you want to have holdings that are likely to do well to reduce volatility and take advantage of high return opportunistic investments. To be clear, some of the distressed debt funds that we're investing in, prior funds across cycles in the top quartile of performance have done over 20% a year through the cycle. So we think about it differently. We want the investments that are going to do well when the economy is doing well, but we also want these counter-cyclical investments to protect portfolios. This is not predicting some economic malaise, the economy doing poorly, or the US stock market crashing. It's not that at all. This is simply a different market that has these micro dynamics we talked about. Leverage being granted when the Fed funds interest rate was 0 or 1%. Too much leverage being put on these private businesses that are essentially like small micro cap companies with 6.5 plus leverage. When these businesses change, the cash flows change, their capital requirements change. Maybe the competitive environment changes. That can bring EBITDA down and cause these debt dynamics to shift drastically. So it's not a call on the economy. We're taking advantage of these micro factors that are happening at the company by company level in private markets. Because look, rates are now higher. Business dynamics and competitive dynamics change. Quality one day for a business can turn into low quality the next day, and now they have too much debt. All of this creates opportunities to be opportunistic on our terms. So imagine this, you've sold a business. Instead of investing all of that capital in pro-cyclical public stocks and bonds that only do well when everything's perfect, it makes sense to have a portion of that capital in other counter-cyclical investments where capital can be deployed in areas that aren't doing so well. That way you can make money and lower volatility through the cycle. But most people's instinct is not to invest in areas where things are potentially going wrong. They want clarity. I'll wait until this happens and then I'll put the money to work. At that point, the opportunity's gone. The best opportunities, they don't feel comfortable. They're certainly not obvious. And you're not going to find them on the front page of the Wall Street Journal that are consensus to you and all your friends. The best opportunities require preparation. They require committing capital before the opportunities are obvious and the recovery is apparent. It's just like when you were running your business. You weren't thinking about the next day, the next week, or the next month. You were planning quarters, years, multi-year periods ahead in order to capture those opportunities in your business. Investing is no different. When it comes to only pro-cyclical investments, that can lead to lost decades, higher risk, and missed opportunity.